Over the course of the last 40 years, we've been riding a debt super cycle which appears to be drawing ever closer to its logical conclusion. Today we explore how this may end, so let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Our authorities and mainstream Keynesian economists tell us everything is fine and we're heading for a new recovery by building back better. Ultimately, I believe that there are three potential types of economic outcome that we'll see in the short term, being largely this year. We'll then consider where these three distinct paths may lead. Now, this chart provides us with the key context and background information highlighting the 10-year US government bond yield or rate of interest on US government debt. We can see how we have enjoyed a period of falling rates, disinflation, asset price growth, and of course increasing debt. Indeed, these super low interest rates we're seeing right now are not healthy and reflect the culmination of a 40-year debt super cycle. Our economic patient here is in dire trouble. Yet debt loads of this type and even bigger were tackled post-World War II, and this leads us on to our first and most desired potential outcome for our mainstream economists, and that is one of strong growth with subdued inflation. Debt would continue to rise nominally, but as a percentage of GDP, it begins to be reduced as the economy's prosperity takes off. This really is the Keynesian dream, as advocated by the likes of Paul Krugman. Ultimately, this would require further state expansion, and that debt would be subject to ever greater diminishing returns to scale. Nonetheless, our Keynesian foe highlight the success of such a strategy following World War II's massive public debt loads. Now, I see this as a very low probability outcome. And so how did this strategy of debt reduction work after World War II? Well, debts could rise in nominal terms but fall in real terms and as a percentage of GDP. The reason for this can be considered via some simple budgetary arithmetic and by considering the government's primary deficit against its debt load. Now, the primary deficit is simply the government taxation minus its expenditure, and it does not include the interest payments on the debt. So a well-known formula tells us how big the primary budget surplus is as a percentage of GDP, B star, which is required to prevent the debt ratio, D, from rising. Now, the formula is as follows. Here, R is the real interest rate, the interest rate on government debt minus the rate of inflation, and G is the rate of growth of real GDP. This formula shows that if the real interest rate is less than the growth rate, it is possible to reduce the debt ratio. Indeed, the 1950s and 1960s, the UK was largely running primary budget surpluses. That is where taxation receipts were greater than government expenditure, excluding those interest costs on the debt. While the real interest rate averaged around 0.2% and average growth clocked in at around 3%. Consequently, and most importantly, R was less than G, and that allowed the real debt load to fall as a percentage of GDP. Unfortunately, right now, Western demographics are far less favourable than they were back in the 50s and 60s. While numerous policies, such as the design of forthcoming CBDCs, really does not look constructive in terms of actually supporting SME growth, as I've discussed previously in this video. And then there's the enormous fiscal deficits, which are set to persist, unlike in the post-war era. And if growth were to rise strongly, bond yields would normalise, causing R to rise. This would happen as investors sell bonds for cyclical growth assets, and this would greatly undermine the strategy as a pathway to prosperity and cause the end of this debt super cycle. Second, sluggish to moderate growth accompanied by uncomfortable levels of inflation. That is a stagflationary environment. This would see the growth rate and the real interest rate roughly equate to one another. As yields rise to combat inflation, however, taxes could instead be used to dampen inflationary pressures and dampen demand, but this would only serve to diminish economic growth, of course. Thus, if growth does not exceed real interest rates, debt as a proportion of GDP would rise as deficits persist, and bonds would sell off, sending rates higher, and the sovereign debt crisis would begin. There would appear a much higher likelihood of this for countries such as the US, who may experience bifurcated growth, where the red states may well outperform many of the blue states, and some inflationary headwinds certainly do appear apparent. Now, the third pathway is one of persistent inflation with anemic economic growth. This is the Sovietization scenario. Soaring deficits here would cause all manner of concerns in the government bond markets, and rates would need to rise dramatically. A sovereign debt crisis would therefore begin, and everything would unravel spectacularly. I am concerned that this may well be seen in Europe. Yet all three pathways would appear to lead us towards the same final destination, the bursting of the liquidity bubble. Moreover, it will represent a multi-generational top in bond prices in the summer of 2020. Yes, they could certainly bounce downwards from here, but they are likely to reverse steeply upwards. But certainly the days of the massive liquidity bubble remain numbered. Clearly, we are now heading towards an ultimate reversal in this long-term debt cycle that means we go from a 40-year regime of disinflation and falling interest rates and rising debt levels to an inverse multi-decade regime of rising inflation and rising interest rates. But the popping of this liquidity bubble is likely to be quite something to behold. I had been thinking this would likely be next year, yet recent activity in the market shows that this may well take place later this year, perhaps in Q4. Our authorities remain desperate to spin this out, extend the old and accelerate the new, but the time is ticking and the liquidity bubble grows ever larger. Navigating this bubble is crucial, as all assets are going to be hit hard. But if there's one thing we know, it is that the crisis response from authorities and their desire to actually exert control will be even greater than the last. And it's likely to require some really tough decisions to actually be made on their behalf. Now, thanks so much for watching. I do hope you're all doing well out there. Do look out for any imposters posing as me and offering WhatsApp support. So watch out for that. And I look forward to seeing you next time. Bye-bye.